Gravity. 7th floor.
We'll see you around the timeline. Feels good to be back.
I think that Rollup is one of the most premier media brands in crypto, and Andy and Robbie are great experts at everything they talk about, and it's my favorite podcast.
Adding it to my library as we speak.
Potentially multi-chain deployments.
We are at DevConnect Day 1 here. I'm with Jesse from Base. JP Morgan, BlackRock, DTCC, Fidelity, the entire thing was just institutions. It's next level. This industry is going to the next level. And guys, I don't know what else to say. I'm bullish.
He said it, he finally said it.
I'm so bullish.
Andy's bullish, I'm bullish, we're bullish. Is headed to the top. If we're not already at the top, we're going to the top.
We're going.
Rollup is my favorite.
From all walks of life, all over the world, all over this industry, come together for the roll-up.
Zoom out. The institutions aren't coming. They're simply here. It's the golden age of crypto, guys. Get right. Let's go.
Welcome to the nest. See you on the show.
Ladies and gentlemen, happy 420, baby. Happy 420 to all the celebrators in the world out there today. Hope you guys enjoy your nice stoniness. Robbie is unfortunately still under the weather following his wisdom teeth removal. Let's give some love to Rob. I know that we miss him here today on the show. We really want to get Rob in the show. He'll be back soon. Ladies and gentlemen, what a weekend. My God. Okay, Saturday, I'm on the couch. Turns into 48 hours of monitoring the situation. We're going to talk all about it, guys. Welcome to Tokenization Tower, the Nest, broadcasting live from the Empire State Building. Beautiful sunny day today. Shout out to Plume, our lovely friends here at the Nest, powering the Tokenization Tower, powering the Nest, powering on-chain infrastructure for the future of asset management. Guys, let's get into today's topics. I want to get through this quick because I really, really want to talk about what the hell happened this weekend. All right, so we're live from Tokenization Tower. Again, Robbie is unfortunately not able to make it. Market and Weather, live from New York. Blueprint Finance's co-founder is going to join the show. Obviously, a DeFi protocol, a long-time standing builder in DeFi. You can assume what we're going to talk about. Dragonfly's GP joins the show. Rob Hadick, long-standing investor, long-standing participant in the markets. You can probably allude to what we're going to talk about. Today's topics are powered by Trezor, Trezor.io, using code Rollup10 to get your Trezor now, one of the best self-custody wallets on the market. Ladies and gentlemen, happy Monday, happy 420. It was not a good weekend for DeFi. Let's move on into the weather and the markets. Before we do, I'm gonna tell you about our friends at Frax, Frax.finance, open, stable, borderless, building the infrastructure for the future of digital money. These guys are safe, marked safe from the infamous exploit this weekend. Fortunately for Frax, not the same for the rest of the DeFi ecosystem. Guys, it is a little chilly today in New York. I think it's 46. Feels like 42. It was a puffer day this morning. I know last week we were saying that the trench coat weather is gone. Fortunately, it is back. I might have to wear the trench coat tomorrow. Today I did not choose to. Today's weather is powered by Relay, Relay.link. Some of the best cross-chain swaps in the industry. Guys, also marked safe from the exploit over the weekend. Shout out to Relay, doing some amazing work in the cross-chain swap ecosystem. Let's get into the markets, guys. Yeah, so actually not that bad. Considering what happened this weekend, this is not that bad. I mean, this could be a lot worse. I think it's signs of the marginal buyers and the marginal price changers, if you will, of the market are no longer, small wallets on chain or those who are frozen. It is institutions. Tom Lee came out and bought a ton more ETH today. I think Saylor announced a $2.5 billion purchase of Bitcoin. A lot more talks now about Saylor getting too big. Don't blame them. I think he is quite a big buyer, quite a big owner of Bitcoin now. Bitcoin sitting at 75.3, Ethereum 2,300. A lot of liquidations on chain around 1,800. We do not want to see Ethereum fall here. For the sake of these frozen markets on Aave and for the rest of the ecosystem, and for all the looping that is currently in a negative APY, we do not want to see Ethereum fall here. Solana at 85, Chainlink hovering on that same $9 mark, and Near also hanging around that $1.35 mark that it's been for quite some time. Apparently the strait was closed again, or the war is restarted. I don't know. I don't think people are really taking what Trump's saying as much at face value anymore. I think they're starting to kind of think a little bit differently about what they hear and what their take is from Trump's kind of nonsensical back and forth about this Iran situation. So on the macro side, oil had a bounce over the weekend. Apparently, again, there was some kind of reopening of this strait, reclosing, reopening, more kind of strikes. But I think that the max fear is behind us. I think the war max fear, the macro max fear is likely behind us. What I don't think is behind us is what we're about to talk about, which is what's happened this weekend in DeFi. If you've seen any of my tweets, I was covering this pretty much from the moment it started all weekend, being a couch warrior, monitoring the situation. And yeah, it was not great. So we're going to talk about that now. Today's markets prices powered by Zama, the best confidential encryption computing layer on chain for private transactions, private tokens on Ethereum. Let's give them some love. These guys are pushing forward and powering our digital markets prices. All right, it's time to get to the news. It's time to get to the news. And boy, oh boy, unfortunately, was it not a calm weekend in DeFi. Before we do, let me tell you about Near, our premier AI partner. Ladies and gentlemen, the blockchain for AI and AI native applications and autonomous agents. Start developing today at near.org. Use near.com for any of your cross-chain needs or near.ai to learn more about OpenClaw and IronClaw, their iteration of a private, secure OpenClaw. All right, guys. Where do we begin? I have a bunch of tweets here that we're just going to cycle through. And I guess just at a high level, what came to be known now is there is a one-of-one layer 0 decentralized verifier network, also known as DVN, that had an internal compromise by some sort of North Korean DPRK nation-state sponsored group. They were able to basically sign a transaction under a one-of-one layer 0 managed and controlled DVN that Kelp DAO had effectively given all power of their, let's call it decision-making to layer 0 in this context. Then the exploiter was able to take that RS ETH that they were able to mint out of kind of thin air and deposit it into Aave and create a situation of bad debt. They were able to borrow a ton of ETH, wrapped ETH, leaving a lot of the wrapped ETH holders on Aave now in serious trouble. Aave's markets are frozen and the rates are going crazy. And so what you can see here is the cost to borrow USDC on Aave is at a level unseen since the SUSD APR was 15% during the very speculative days of the basis trade in the bull market in the end of 24. And so you see this very sharp rise in the cost of borrowing. And so what this is doing right now is you can imagine a lot of these people on Aave are doing these aggressive looping trades, right? Where you put in like for example, with RS ETH, this restaked ETH that's powered by Kelp DAO, they're putting in this asset, borrowing normal ETH against it, re-entering that original collateral asset, the RS ETH, borrowing more ETH, and doing this like, 8 or 10 times. You get a nice yield. The collateral asset and the debt asset are the same. And the rates are such that you can basically create this loop that juices your yield on ETH. And so what's happening now, though, is that the stablecoin pools are getting affected. And so basically, the APY of USDC on Aave is now the highest it's ever been. This is very, very problematic for stablecoin loopers, right? So if you're a stablecoin looper right now, I mean, the borrow APY is absolutely skyrocketing, but your lending APY is still around, I think it's somewhere between like the 3-4% range, maybe got a little bit higher, but not much. And so you're operating at like a significantly negative APY. And then by looping it, you're basically leveraging up. So you're amplifying the negative returns. And a lot of these funds, if not all of them, are locked. So Aave loopers are in a really, 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 really bad scenario right now. And it hurts to even say it. Like, it really just hurts me down to my bones to see that the most trusted lending market in the world is dealing with this on-chain right now. And there's a lot of different opinions as to who's at fault here. Let's get over to the next post because I think this is a good segue into the conversation about who's at fault. So Kelp DAO is actually planning to put out a memo that basically says that they're not at fault. And so Layer 0 puts out this post, right? After this happened, this was about 8-10 hours ago. They effectively blamed Kelp DAO for using a one-of-one DVN. And in this post, they explained how their internal system was compromised, but they ended up effectively blaming Kelp DAO for not listening to them and heeding their advice to become to not be a one-of-one, what people on Twitter are calling a mono-sig, right? And so Kelp DAO apparently has leaked an internal draft of their upcoming public response, saying that it relied on Layer Zero's documentation, default configurations, and team guidance when setting up this bridge. So you've got finger pointing from the two protocols that were directly involved in this, which is not what you want to see as a user. And then you've got Aave coming out and saying that the RS ETH on mainnet is completely fine, and that basically what you could infer that they're suggesting is that the L2 users of Aave might be in big trouble, and that they might want to maybe encourage Kelp DAO to save mainnet users rather than L2 users. And so what you have here is you've got 3 levels of fault. And I think there's a tweet from Viscontis that explains this well, but I just wanted to present this to you. So this is happening. So Kelp DAO is getting ready to come out and say that they are not at fault and that they're getting ready to blame Layer Zero for being at fault. So let's get to what Aave said first. So this is what Aave said first. This was before this Layer Zero post came out and before this announcement from CoinDesk came out. They're basically saying that the RS ETH on Ethereum mainnet is fully backed and that RS ETH remains frozen across Aave v3 and v4 and exposure to the incident is capped. But WETH markets also are effectively frozen across all of Ethereum, Arbitrum Base, Mantle. You can kind of think of like the entire Aave protocol is more or less bricked right now. Like, it's more or less bricked. And so users are not able to pull out their wrapped ETH. And when I say users are not able to pull out their wrapped ETH, I mean some of the safest low-risk DeFi users who had simple wrapped ETH deposited into Aave, ETH into Aave just to get a couple extra points of yield, are not able to pull their funds out. That's a problem. That's a big problem. And the longer that these protocols remain frozen, the more worrisome I become, and the less trust these users are going to have in this system longer term. And so those are kind of like the 3 angles happening. Now let's kind of get into like who's at fault here and what actually happened from this chronological order based on the actual event itself and then the public comms. So Wei Dai came out and he put out a post kind of TLDRing what Layer Zero's announcement was. He goes, Layer Zero, Kelp DAO, please don't use one-of-one DVN. Kelp DAO, no, can we please just use one-of-one DVN and you operate the single DVN for us? Fine. If you insist, we will do it. Layer Zero gets hacked. Hacker minted RS ETH for free, took $200 million of ETH out of Aave. Layer Zero. We told Kelp DAO not to use the one-of-one setup. They didn't listen to us. But Layer Zero operated the one-of-one DVN node. Also, how did Aave allow a one-of-one DVN asset into their protocol? So when I kind of think about the layers of like fault and risk here, number one is if you're running a protocol that is managing $1.5 billion of TVL that is an externally managed one-of-one signer, you are just you've completely lost the plot of what we're trying to do here. Completely lost the plot. That is just unacceptable, irresponsible negligence for users' funds and risk. Layer Zero, running a one-of-one node for a protocol that is insisting that you do it for them, and then not having proper security practices to prevent a exploit of this nature, also completely irresponsible. Completely irresponsible. And then finally, having a curator model from the DAO to not look at the risk of a one-of-one DVN asset from the bridge module, basically meaning that they didn't look at the collateral that they were listing, and this just got listed onto V3 and enabled E mode as of January. To allow this into the protocol is just it's obviously an oversight, but it's a grave mistake. So you've got like 3 layers of fault here. Let's roll it through into Fiskantes because he actually really kind of lays it out from a more like top-down perspective, which I really appreciated. So here's kind of how he's thinking about this, and I'm in agreement for a lot of it. So layer 0 multi-sig architecture enabled one-of-one multi-sigs, even though this is obviously a dumb idea. Maybe giving users all this freedom isn't the best primitive. Agreed. One-of-one multi-sig architecture should never exist for any sort of protocol managing size of users' funds. Then, KelpDAO took this liberty to use a one-of-one multi-sig, which, by the way, guys, I was shocked to see the amount of teams that froze their OFTs, and they were one of ones, 2 of 2s, or 2 of 3s, or in some cases 3 of 3s. Absurd amount. And I think there was probably upwards of 50 teams here that had a one-of-one implementation for their protocol across multiple chains. One signer. And a lot of these is just layer 0 themselves. Now, layer 0, to give them credit, has came out and is like basically saying that this design is never going to happen again in the future and that they are going to reinforce this across all of their implementations of DVNs, which I think is very important. But needless to say, there was probably 50 tweets this weekend from teams pausing their bridges, their OFT bridges, and many of them were one of ones or 2 of 2s. And a lot of them were managed by layer 0. Like a lot of these actual one of ones were just managed in-house, either by the team or they were a 2 of 2. One was managed by layer 0, one was managed by the team. Getting back to the tweet. So KelpDAO took this idea that they were going to put all the security into layer 0's hands. They're going to use a one-of-one multi-sig. It's not even a multi-sig at this point. It's just an EOA. And this was ridiculous. This was just insane. Then Aave took KelpDAO's RS ETH as collateral across a few L2s. Less obvious that this is a dumb idea because you had to do extreme due diligence to figure out that this was a one-of-one asset. And they allow this asset as collateral across a few L2s. And you know what's insane is the chain, and this is what Fiskantes is saying here. The chain that caused all of this was Unichain. It was Unichain. And so Fiskantes is saying that this whole problem is downstream of modular L2 infrastructure requiring bridges to work and hold assets. Being that bridges are a single point of failure, and I've seen a lot of takes on this, that if you don't have a proof system for your bridge in 2026, you're making a grave mistake. But here's kind of like the key takeaways that I also found to be quite on point. Don't give your users freedom to do something dumb. In this case, Layer 0 should have never allowed any of their customers or clients to ever have a one-of-one DVN setup that's required to be used by them internally. That makes no sense. Multi-sigs are insecure. Multi-sigs with one-of-one signatures are extremely so, a single point of failure. Again, something that I think this industry has learned time and time again, that single points of failure are simply unacceptable. DeFi protocols need to reject assets secured by one-of-one multi-sigs or multi-sigs in general, or isolate them to limit contagion. In this case, Aave. Additional safeguards, such as circuit breakers or similar, would help a lot. And I thought this was pretty interesting because you start to get people saying that, wow, like memeing around, like, oh, why don't we have, so this is why they have T+1 settlement, right? This is why they have circuit breakers and limits. And then you had like the Agora team come out and say that they have like these $10 million limits of some kind on their stablecoin bridge. You had Athena come out and Guy talk about kind of how he thinks about this. And you know what? It's an interesting thought because, you know, a lot of the reason that DeFi exists is to get this kind of 24/7, always on liquid markets. But while it's a massive feature, it can also be seen as a bug. And so I think part of what's going to come of this is going to be more rate limits and security monitoring for large size transactions, and effectively like blockages or like security council based rate limiting of transferring massive assets at scale. And then finally, the modular L1, L2 design leads to complexity and increased attack surface. And yeah, I mean, it's hard to disagree with this. The bridge design has caused endless exploits and endless pain for users. And I just can't believe that we had so many 1 of 1, 2 of 2, or even 3 of 3 multi-sigs managing bridges at scale across all of your favorite chains and protocols. And we didn't learn that you need a lot more signers than just 2 or 3. You need a lot more. Let's move on to OX and GMI, and then we have our first guest here, Nick, who we're going to talk more about this with. Just some quick things here from him. North Korea figured out which RPC providers Layer 0 was using. They compromised 2 of the providers to make them return fake data. Again, I don't think Layer 0 was using that many RPCs. At best, I think it could have been 3. It may have just been 2. It may have been 4. And then whoever it was DDoSed other providers to shut them down, forcing Layer 0 to use the bad or the poisoned RPCs. And that's what happened. And $292 million, the biggest exploit in all of DeFi, happened over the weekend. And that's where we are today. And that's where we sit. And the markets are still frozen on Aave. And there's no telling when they will be unfrozen. And we're waiting for a statement from KelpDAO. And ultimately, KelpDAO has the final say here in how they're going to choose to distribute these losses. And so there's really like, from what I understand, 2 paths: socialize it across everyone, or pretty much give it to people that were on the L2s. But they have not came out with any sort of statement. And it doesn't look like this statement that they're going to come out with is going to have any sort of actual real substance towards that issue, as much as it is just deflecting blame from Layer 0's pointed accusations toward KelpDAO. And so you kind of have one of the worst of all scenarios here, where you're seeing real-time legal protection and PvP on the timeline, but these teams don't seem to really be trying to figure out behind the scenes as much as you'd like. And you're just seeing sentiment across DeFi just evaporate. And it's just not the situation that you want to see at all. So, guys, we have Nick Roberts-Huntley here from Blueprint Finance. He leads the development of concrete and institutional grade yield borrowing product and Glow. So he has quite a bit of experience in DeFi. And what better day to have a conversation about the risks and about what's happening. So we're gonna bring him up. I'm gonna get him set up back here. We'll be right back, and we'll be back on the news, back on the topic of the day, of the week, as we watch this event progress and shape up real time. Be right back. Alrighty, guys, welcome back to the Tokenization Tower. I'm here with Nick Roberts-Huntley. Nick, welcome to the show.
Thanks, man. Thanks for having me.
Quite the day for you to be on the show, is it not?
Yeah, I would say before we arrived today, I had not planned for the weekend to happen as it did, of course. But yeah, it'd be an interesting conversation, I'm sure.
Yeah, man. So you are the founder of Concrete, a former surgeon as well, working on the institutional side of DeFi, something that I think is obviously a pressing conversation for us to have today. We'd love to just hear how you went from being a surgeon into crypto, into DeFi, kind of like what that path looked like, and then tons to talk about.
Yeah, sure. I mean, definitely a certainly different path to I think you find most founders in the space.
Yeah.
Having gone through, love my time in the hospital. Was super privileged to have that work. I think fell in love with medicine and surgery more broadly, predominantly focused on like complex system design and problem solving. Got into kind of solving quantitative problems around computational drug discovery, and kind of fell into the rabbit hole of economics, policy, was lucky to study that at a graduate level, and then ended up moving to the Bay Area now close to 10 years ago. Worked on some interesting software, data, quantitative challenges with some large institutions and groups up in Menlo Park, before being fortunate to transfer over into the world of finance, spend some time at Point 72, and ultimately post Point 72 started Blueprint, which operates Concrete and Glow.
And just a quick primer on Concrete and Glow. What exactly are these products? One is an institutional kind of lend, borrow, yield product. That's Concrete. Glow is more of a kind of a separate offering on Solana. Maybe you could just kind of...
Yeah, of course. Very similar kind of value propositions, just built for the slightly different ecosystems. One, Concrete being EVM, and then, of course, Glow being Solana focused. Similar premises, so vault infrastructure, strategies and execution in terms of getting people sustainable rates of return, and then focused on kind of how do we optimize money market control and utilize debt predominantly. So big focus on working with kind of blue chip asset issuers, large money markets, but also just trying to think about what is a sustainable rate of return without taking on too much risk. And obviously, day to day, like we have had over the weekend, risk is obviously an operative word. Yeah. So heavy on making sure that we try and reduce the edges of what can go wrong in DeFi for our clients and our partners. Yes, as you mentioned, heavy institutional focus, working with custodians, financial institutions, and large investment firms.
Yeah, awesome. Well, there's an ongoing sentiment right now that is DeFi is simply just far too risky for the yield that you get. And this kind of happens in higher interest rate environments. What you get is usually a bit of a compression in the crypto market itself in terms of lower prices, a bit of like a bear market, kind of sentiment down. Rates on chain typically are inversely correlated to the actual central bank interest rates, just because low rates in the central bank drive more speculative activity, which is a net positive to crypto. This drives more borrowing on chain, which spikes up the borrow rates, gives people higher stablecoin yield, even though that the central bank interest rates are quite low. And so you get this period of time where on-chain yields are far better. And then the opposite happens, where central bank yields are quite high and the risk-free rate is quite high. Thus, the desire to borrow on-chain goes down because, well, people aren't going along on crypto, basically. And that's kind of where we sit right now. And so this was kind of stemming and this was growing, and then obviously bang, this weekend just kind of put a nail into that wall. And so let's just start with this kind of concept broadly. Like, how do you think about the risk to reward of systems broadly? And as it pertains to DeFi, what are we missing here? Like, is this risk to reward just wrong?
Yeah, it's a great question. What we're really talking about is how productive can we make these assets against the risk of carrying that for some duration. What is the cost of working capital against those, which is obviously what generates kind of flows and borrow lend on the money markets, which is the predominant activity or base of liquidity within DeFi. Look, candidly speaking, we've had this extraordinary explosion of just the sheer number of tokens that are available, which creates a lot of fragmented pools of liquidity. Certain mechanism designs, as we've seen over the weekend, particularly through Aves, kind of pool function, mean that certain assets are considered nearly like for like in terms of their quote unquote debt worthiness. They go through rigorous risk assessments through third parties, et cetera. But as we start to continuously create these extra layers of networks, money markets, assets, LRTs, LSTs, raw tokens, wrap tokens, whatever it might be, that creates just an incremental amount of extra underwriting and consideration that we need to take on. And then, of course, you have the underlying infrastructure, which is the way in which these funds are transferred, moved, accounted for, verified. And so you build this kind of layer cake of dependencies across the stack, both in the underlying backing, the asset issuers, the infrastructure that controls it, and candidly, like the third-party underwriting of those assets as their utility as either collateral and/or working capital within the assets. The interesting thing that I've noticed over the last couple of years, say since 2021, kind of the golden era of DeFi when everyone was having a lot of fun, there was a large push back then to talk about utility of these tokens. Like, what could these tokens necessarily enable you to do on-chain or in the real world? A lot of that has kind of faded by the wayside. A lot of the utility-focused discussion has headed directly back into the use of stablecoins. And we're looking at the non-stable assets as effectively ways to accrue long value. And last year, we saw a massive appreciation in token price. People really started to say, hey, if I can generate a couple points on that non-stable asset, it is now a productive tool for me in terms of generating cash flow, just because the token price had appreciated. Now, obviously, at token prices where they are, that rate of productivity, even through good kind of asset allocation and risk control, isn't that exciting. And that gets us back to the kind of risk-reward debate, which is raging on right now, and rightly so, given the weekend. It's where we cut our teeth and where we spend our days. It's something we spend morning, noon, and night thinking about and trying to make sure that our clients are protected.
Yeah. I'm curious how you think about this looping trade that's been ongoing for the last couple of years. I mean, it's been like the primary driver of on-chain yields for larger amounts of capital, right? You could, put two assets of similar, or, usually a wrapped version and then a non-wrapped version. You deposit this wrapped version, whether it be a wrapped staked ETH, gives you a bit of extra yield. Then you borrow this ETH, reallocate into the wrapped version, and just kind of loop. You can also do that for stablecoins. You can also do that for USDE, for USDC. And so it's been a very, very big part of like the DeFi TVL, just in general, has been looping. And now a lot of these looped assets are stuck on Aave today. Yeah. A lot of the wrapped ETH depositors and stablecoin depositors are stuck. Was this always bound to happen, in your opinion? Like, was the looping trade doomed to start just due to some collateral part not being as safe as perhaps folks thought? Like, what is your honest and just kind of broader view of looping as a construct? Where do you think we go from here?
Since we launched in December 2024, we've been very staunch and very kind of stale on the fact that we don't operate loops.
No.
We have not engaged in any meaningful kind of looping strategy at all. And I'll tell you a little bit as to why we think that. You're right, it drives TVL reportedly very much higher. Generally speaking, most accounting mechanisms on chain don't necessarily allow for you to disintermediate between what is looped volume versus what is principal. Yeah. The other thing is, if you look at the yield kind of curves or the yields that are available to you on a looping trade, very rarely do they actually net out to what you expect them to. They're normally subsidized by token emissions, points, grants, some kind of reward system for which that protocol or that asset issuer is incentivized to give you. Now, you're basically getting paid for risk, which is the trade between risk and reward. Our stance has largely been that while those rates may appear very attractive, the probability of actuating those to your balance sheet is not that interesting, particularly for our clientele. And we like to say, look, there's some sort of sweet spot. You can go and loop for maybe what we saw last year of 20, 25, 30%, or wonderful numbers to see. But I can tell you, coming from a traditional finance background, if 20 to 25% was so easy to get from my sofa at home, and a lot more people would be retired in crypto.
Right. Yeah.
Then you move down to the other end of the curve, looking at money market funds, maybe spreading between 3 and 5% at its peak a couple of years ago. That's interesting, but very, very sure and safe, and that's why people spend time in centralized banks. We try and get kind of the Goldilocks approach. Like, how do we get you a meaningful rate of return above that of a money market without taking on what we would consider edge risk or considered execution risk that we don't feel confident in returning capital to our partners. And I think for us, in the way in which we approach our business, has been loops are a great way to boost rates, but depending on them is maybe a misguided approach.
And so looping as a construct, do you believe that it'll accelerate from here or wind down from here? No pun intended.
Yeah, I was going to say winding down. I hope that we see less of it in the sizes that we did. There's a lot of design space in solving for how you would control upon that, particularly within money markets. It's hard to put a lid on it. There will always be actors who are incentivized to encourage that because of the metrics that it provides to a company, to an asset, to a network, to a protocol. And I don't blame anybody for pursuing that. The challenge is that as soon as you introduce more and more leverage to the system, you're effectively cranking up the sensitivity dial to price action. And so when you see shocks in liquidity or price, and there is an awful amount of leverage introduced into the system, predominantly through looping, getting out of those positions becomes very, very hard, and your yield typically craters.
And that's what we're seeing right now, is that the APY on the borrow side for stablecoins and for ETH has skyrocketed on Aave across all chains pretty much. And so any of these people that are in these looping strategies are unfortunately stuck. And I mean, I've seen different markets from Fluid to Sparkland, I believe, Aave. We're looking at 10 to 14 days before liquidations on these positions.
Yep.
And that's happened just like that.
Again, I think it points to the fragility of those looping trades. If the going's good, fantastic. Continue to print money, everybody's happy. Unfortunately, as we've seen, the snap of a finger, we've basically unwound pretty much all of the available yield. We have no clarity on how people can get out of that trade. Markets are frozen. There's no flow. We're basically kind of paralyzed for the time being until we can see some resolution looking forward and hopefully some positive updates from the counterparties in this.
But don't you think that unlocking the markets is better than just leaving them frozen? I'm missing something here, but I assume if you unlock these markets, there's going to be liquidations that are going to happen for sure, and a lot of redemptions and a lot of basically capital flight. But from a user perspective, to me it just seems like every day that this is going on, even for the last 2 days, the trust deterioration just accelerates very quickly.
I think trust is an important piece here. As participants within DeFi, everybody kind of wants and expects this permissionless and immutable kind of framework in which we can engage 24/7, get access to money markets, get access to capital, distribute to whomever or however we want to at any point in time. And that's the goal of decentralized finance and creating freedom to move assets wherever, whenever. Of course, as I mentioned in that layer cake model, there has to be some inherent assumptions and trust based on the tools and the systems that we use. So there is always trust in which we engage with those systems. I think there's a good intellectual debate to be had about is it right or wrong to freeze and unfreeze markets at the discretion of a small, an individual and or a known counterparty or a consortium. That's why we ended up with DAOs as they were. Yeah. That's maybe a longer, breathier discussion to be had. I think what a lot of the market will not be seeing right now, and candidly, I am not necessarily privy to it, and so can't comment with any accuracy to it. But there are parties at work furiously right now to seeing if there is a way to repatriate this loss. What is the risk reward for a certain number of counterparties to find a way to fill this hole? And what duration would it take for that to be earned back? What incentive mechanisms, what economic levers can counterparties pull? That's what's happening, right? Yeah. It has to be. There is no world in which a major crisis happens, and there is obviously close to $300 million that has effectively been spoilt here within the ecosystem, that there are not people actively working, team to team, counterpart to party, book to book, trying to find a way to repatriate this loss to continue to get DeFi back up and running. At what point do you effectively cut your losses and say there is no way to repatriate this and we have to socialize them? It's a great discussion. We're probably approaching some sort of time at which that needs to be solved for. Yeah. The final leg of the stool is how are those losses going to be socialized, obviously between ETH mainnet and the L2s that are currently exposed. And there is quite a delta in terms of what L2 holders or users would face comparatively to if it was distributed across all networks. It's unfortunately the decision for the socialization has very catastrophic effects on particular L2s, Mantle, Base, and I think it might be Arbitrum is the third one. Yes. Yeah. So those three, if the
choice from Kelp is to socialize to the L2s and effectively save Ethereum mainnet users, those three chains will be left with a big problem.
Yes.
Yeah, like a potentially unsolvable problem up to the tune of like 70 million all the way to 130 million, I think, in the biggest case.
It's a tough one. DeFi for the longest time has been a lot of PvP. And because of that peer versus peer or player versus player approach, ultimately nobody wants to give money away. This is a unadulterated capitalist market where people are looking for upside and looking to protect their downside. I think if you are, speaking plainly, if you are a holder on ETH-L1 right now, you want these losses socialized across L2s.
Yep.
And the same can be true for the other parties.
Yep.
It makes pure sense. Everybody is trying to protect their position. It's challenging, of course, because you now have to get into the underwriting and understanding of like who is potentially at fault, who would be the responsible party in order to repatriate some of these losses, absorb some of the losses, reduce the hit that the market takes. Is there a way for us to get everybody to take a tiny haircut versus a more select number of individuals taking a heavy, heavy loss? I don't know. We'll find out in the next few days. As always, just to be clear, during events like this, there are counterparties out there making extraordinary returns on this volatility. There's always two sides to the trade. This is a terrible situation for a lot of people. But of course, this is a free and open market. And people who are connected, organized, have the right infrastructure, have the right knowledge base and the right resources are currently making money on this trade. We'll see how long it plays out for.
Yeah. There was this idea of low risk DeFi that was kind of consistently talked about over the past couple months, at least 6 months to 12 months. Kind of this idea of rather than building this kind of casino on chain, we just build a resilient system for low risk, low yield, really solid DeFi. Aave was kind of like the main backbone of that, if you will. I'm just curious from what you think the ramifications are from the institutional side, from the kind of trajectory that DeFi has been on as far as adoption goes. The last year has been massive. I think we're getting to a point where a lot of these tokenized assets are trying to come on chain, trying to be collateralized, being used in different dexes. Like we're starting to kind of see this next wave of types of different assets coming on chain. I'm just curious, like from your conversations, from your work, from your interacting with folks that are trying to design systems such that they don't face these types of exploits. What do you think the ramifications of something like what happened this weekend are on that progress, on that kind of like snowball that's been rolling, and like what do you anticipate to change from the trajectory of DeFi?
Yeah, of course. Anytime you see a major event within any market, typically you find kind of belts get tighter and pockets become a little bit more sewn up. You look at the global macro right now, given the volatility and the events going on in the Middle East, we've obviously seen flows constrain. We've seen people looking to be more focus on capital preservation, waiting for the right opportunity to re-enter. We'll continue to see that here. I think, talking to the team internally over the weekend, this looks a little bit like a couple of years ago. There was a period of extended hacks, breaches, losses, bad actors kind of drifting out. It sometimes feels like a little bit of escape gas before a market regime change. I think what Guy succeeded in building at Athena came out of a period post that kind of frequent hack behavior. And I think that was an interesting mechanism by which we had seen everybody had moved all on chain all the time. And ironically, obviously, Arbitrum's in the crosshairs of potentially a loss here, but a wonderful ecosystem that we all enjoyed playing in from a DeFi perspective during the bull run of 2021 and 2022. Everybody was fully decentralized finance, governance tokens were the rage. Everybody wanted to participate, and it was like real deep cut bare metal stuff. After a period of time when that flow dried up and there was just less retail capital participating, and it had consolidated around a few actors due to the fact that PvP is a very straightforward game. The best people typically win over a long period of time. People needed more trust. People wanted to find a better venue. And that was when the cash and carry trade really played out between centralized exchanges and on-chain holdings. perhaps we're headed into that next new era where we'll find a slightly more, a different looking, but perhaps a comparable outcome. We run trades using centralized exchanges as well as on-chain venues, and maybe that hybrid model needs to come back to get the right balance of trust and execution with the cost benefits of being on-chain.
Yeah. So let me take this to the furthest point of the logical extreme here then. Something like Canton is like, you know what, we're just going to black box this thing. It's going to be a permission chain. We're going to make this very different than traditional blockchains in terms of we have this global synchronizer. We have kind of these super validators. Effectively, what we're doing is we're building our own version of what we think that this ecosystem should look like, and we're going to do it in this manner. It's going to be private. It's going to be institutional first. In order to get a wallet, you have to be on a wait list. You have to, you have to get invited. It's not just permissionless. Like, where do we, like, Ethereum DeFi is like maybe here, and Canton is maybe here. Like, is maybe we're going somewhere in the middle in the future? Like, kind of, if we take it to a logical extreme, we get all the way back to TradFi compared to like where we are. Where do you anticipate because for example, folks were suggesting rate limits on bridges, right? So let's say there's a $10 million every hour is the max that you can bridge out, or in a minting process for a token, again, $5 million every 10 minutes or whatever it is, or even doing something like rate limiting by like a region, or you start to think about like, okay, we're just building T+1 settlement again, or like, oh, we're putting capital controls on what we promised it was going to be this 24/7 open permissionless market. So like, using this kind of spectrum in mind, how do you envision these types of newer primitives to DeFi, but always having existed in TradFi coming to the market? Like, do you expect capital controls? Do you expect rate limits? Like, how do you think about a more secure and resilient on-chain market?
I think there's two parts of what you're describing here. One is like, candidly, just the technical components, like what can be built and deployed on-chain, and can it function? The answer is predominantly yes. There's wonderful builders and engineers and great teams across DeFi and crypto more broadly. And I think you brought up Canton, and I think what Yuval and the team have built there is incredible. And to use that as a kind of an example here, they built something that they knew there was a willing and wanting participant who had, inherently upside to using that process. And that was predominantly large, entrenched, traditional financial organizations. They built a system that spoke to a market and a participant that was there and would be readily able to benefit from it in terms of what the services and the technology they offered, and they met them where they were. I think on the other side of it, we have a slightly more distributed view on what gets built in DeFi. We went through that period of just building anything and saying, well, build it and they will come. Yeah. I would take the counter to that. I think the people that will come to use those bare primitives have been, and a lot of them have made their money, and a lot of them are not that active, and then a lot of them sitting on significant pots of capital are not going to take the risk that they inherently did in the earlier days of DeFi because they want to protect their pot of capital, and they took their risk early on, and they're not going to continue to take it anymore. Yeah. What we really care about, and kind of where we position ourselves as a company, is there are a lot of wonderful standards and well battle tested core components across DeFi. And how do you actually layer those into a cogent, defensible kind of infrastructure stack for people to remove the complexity? Because it's our thesis that there isn't a huge amount of traditional retail participation in DeFi right now. There was an influx of retail activity around the kind of mimetic theme and meme coin race through kind of late 2023, 24, 25, as it kind of really crescendoed. What we have seen then is, as that has drained away, there hasn't been a new resurgence of on-chain activity from traditional retail. So in order to get what I think is the next wave of participants, you have to get them to a point where they're willing to trust the system that you built. It has to look and feel like something they're familiar with, to the point about what Canton has achieved. And then on the other side of it, I think ease of use. People talk about UX and reporting and accounting and all these things. They really matter. So for us, it's a case of take wonderful things that have been built by really smart and talented engineers, compile them in an elegant fashion that gets people the right risk reward for being a participant within the ecosystem. Yeah.
And so just a bit more concretely here, yes, we will see kind of more of these like rate limits and these types of practices on chain, or not so much?
You're going to put me on the spot. I think,
I'm just like curious, like how you think that evolves. Yeah.
I think we should want for people to put more controls that are net protective to the ecosystem. But in a weird way, I used to study policy, and these are enforced regulatory frameworks. But decided by whom? Is there the great DeFi council who determines which protocol can control what flows go where and of what asset? Of course not. We don't necessarily have great regulatory clarity. And so now we're distributing regulatory controls on asset flows and money markets into, candidly, either a distributed network of individuals in a DAO or the operators of a protocol who have sole discretion on what happens here. That's going to be a really fast learning curve because those things can be shipped quickly, and we will find out very quickly from the market whether they are well received. There are obvious upsides in terms of mitigating downside if there are rate limit controls on these systems to make sure that truly anomalous flows don't necessarily occur. But now we're going to start saying, well, hang on, should we just make the flows only maxed out or capped during the weekends or out of hours? And what time zone do we use? And where do participants need to come from? And what should be the history of the wallet that engages within a particular protocol? We end up creating a lot of complexity here, and I'm not against it. I'm not against putting in stronger, more defensible and rigid capital controls around participants, particularly when moving size around. Protects retail. That's why we have regulations around laws, registration of large financial institutions and investment partners to make sure that they don't bully retail and they operate to a certain higher standard. Is that what DeFi was about? Maybe not. Is it where we're going? It might be.
Yeah. So an ironic anecdote or kind of thought experiment that's been going around is, well, don't use DeFi and Ethereum. Just buy STRC, Sailor Stretch product. Just buy a stretch product, get your 11%. You're basically getting yield from a similar thesis, directionally similar, different in terms of how it's actually operated. But you've got a guy who's going out there and he's gonna buy a bunch of Bitcoin, and you need Bitcoin to, remain somewhat elevated here and at least not dump a lot for a long period of time. And you're going to get your, now twice a month yield payouts in terms of your dividend. And you're going to get 11% a year. And you're basically just betting that Bitcoin doesn't go to zero or doesn't go down a lot. Is Stretch just like a better yield product than Ethereum DeFi now? What's your kind of holistic view on the comparison of something like Stretch versus like a yield product on Ethereum or kind of on chain?
Look, fundamentally, they are completely different products. So when we talk about yield, yes, 11% is greater than a lot of people are offering right now in DeFi. So if you're just looking for unadulterated rate of return, maybe that's the right thing for you. If you think about the other costs and considerations that you need to take in participating with effectively a registered product, there are considerations around tax. There are considerations around, effectively how do you manage that position, how do you register it. That feels more familiar, for sure. And are you basically comfortable with taking that bet both on the counterparty, right? There is still counterparty risk here in the organization that you're trusting to perform over a long duration of time. And then, of course, you're underwriting, to your point, the performance of Bitcoin, perhaps, given its current structure. That can also change, and you have no influence over it. So how that product and how that solution is managed for you might change, and you won't have anything you can say about it. Now, the other side of it is like, why could DeFi be better, I think, is the question that you're really asking. Like, why is DeFi a better choice than sitting in a Stretch product? Well, one, I think if you believe in DeFi, you're interested in having a say over your financial future. So you actually buy into the doctrine of being a participant within a decentralized financial network of which you have underwritten, and you have taken the ownership and responsibility of investing in that environment, and you are happy with what the up and downside might be, and you are fully aware of those risks. Inherently in that decision, you should hopefully be able to underwrite whether the institutions or the organizations that are moving your funds, offering your product, or securing your assets have done their job well. When a series of bad events occur, like it has this weekend, that trust can be really fractured. Does that change the doctrine of why a decentralized financial system should exist? No, we just need to be better at underwriting and managing those risks. The next question then is, okay, so on a first principles basis, if you believe in the decentralized financial system, you should probably still participate because you believe in that and you're not just there for upside, you're there for autonomy.
Yep.
Now we're talking about rates of return. DeFi rates are not that impressive right now. People producing rates of return need to either diversify and think about novel ways to create that without inherently taking on too substantive a volume of risk. And they also need to understand exactly what the hell people are looking for. Is it a case of utility-focused asset return? Is it about yield products, diversification, long-term upside in terms of farming rewards? You know, we went through the whole airdrop period for a while where everybody was just farming, and then just dumping tokens as soon as they came out, and teams were kind of finding a way to finagle some money and success through that.
Yeah.
There will be a new narrative that emerges. It will be a core spark that will lead to greater rates of return and more grease coming into the system. Personally, I think we'll probably head back to a bit more of a hybridized system where we will get more participation with the centralized exchanges meeting DeFi. We will find inefficiencies and opportunities to arbitrage the performance of those two systems while maintaining the fluidity of DeFi and managing it. There's a lot of money in DeFi still. I know Aves obviously sadly had a big withdrawal over the weekend, but there's still a lot of money going around. There's still a lot of yield. And there are some great people in the space. You know, we'd like to count ourselves among that crew of people, but there's a lot of upside and a lot of worth in being a participant within DeFi, and we're grateful to all our customers, of course, and participants. But I think any balanced portfolio should have exposure to traditional financial instrumentation, digital assets more broadly, and I think it's fiscally responsible in the modern era with the dawn of micropayments, stablecoin growth, even micropayments and agentic payment frameworks coming together across AI. People should be curious and people should be participating within this ecosystem.
Yeah, definitely. Yeah, I mean, it's a sign of maturity that the Ethereum ecosystem has had the biggest exploit of the year. The asset itself hasn't really moved much, nor has Bitcoin. It really just it's showing you that the marginal buyers or the marginal sellers are not on chain anymore that actually dictate the price. They're very much so large ETF buyers, DApp buyers. Saylor and Tom Lee both came out this morning and said, I think Saylor announced a $2.5 billion purchase. Tom Lee, maybe another couple $100 million or something. So the buying is just going to continue. It's more of this like losing of the sentiment of like, what are we doing on chain? How is it there was a tweet that came out that was like, I mean, it was a troll from Eric Wall, but it was, people are gonna get mad at me, but why is DeFi necessary? Mm-hmm. And it's just like that kind of sentiment is where we're currently at.
Yeah. You'd like, having been through a couple of cycles now, you'd like to think that we're headed towards the bottom of whatever sentiment is going on. It's not a pretty picture out there.
Certainly.
We talk about market cycles for a reason.
Yeah.
Things go up, things go down. How you time it and how you manage your risk is the most important thing that's going to lead to your financial prosperity.
Yeah.
I think that a lot of what we see on X, on whichever social feed that you're following, it's to draw attention.
Yeah.
That whole system is to get your eyes on it.
Of course.
There's obviously some wonderful writers, bloggers, threaders, etc., who give really, really fantastic information. It's hard sometimes to sift through the noise that's out there. And of course, it's sometimes quite fun to read the trolls in the comments and at least take it with a pinch of salt. But we need to have a little kind of ecosystem discussion about how well we're managing risk and are we keeping ourselves to operational standards for sure.
Yeah. Nick, appreciate you spending some time with us today, man. Hell of a weekend. I'm not sure this was the planned topic at hand, but it doesn't feel like there's much more important to talk about, so I appreciate you.
Thank you very much, man.
Thanks,
Appreciate
Nick.
the time. Thank you.
All right, guys, we'll be right back with our next guest. Thanks for joining in. Crazy weekend. You can feel like the somber in the air, but we're trying to stay optimistic, trying to stay bullish. Markets don't seem to care. We'll be right back, guys. title. Alrighty. Yeah. So back on CalpDAO, guys. That was Nick Huntley. If you guys are watching in Restream or on YouTube or on X, I'm checking the chat. I'll check it out right now. I think Atan's gonna get active in the chat. There's Rob. Rob's in the building. We're gonna get him up. Basically, yeah, man. I mean, this was just a very, very, very hectic hack. I see you guys. Concrete roadmap, CDFI not real. The biggest CDFI. Let's go, Mr. Canton. Roadmap. Yep. Good to see you guys in here. Yeah, I mean, guys, this has been insane. We're going to get Rob from Dragonfly on to further discuss what is happening here and just to kind of get some insight into his perspective on this CalpDAO incident. But this is the statement from Layer Zero. And I think there's a couple things to highlight here that I think are a little bit, I don't know, a little bit iffy. First one is there's zero contagion to any other cross-chain assets or applications. If you give them the benefit of the doubt here, I think what they really mean is that none of the other OFTs or OAPs have been affected. That being said, 50 protocols paused their bridges, and we're very clearly seeing contagion in Aave. Like it could be Aave, Mantle, Athena. It could be an entire suite. Okay, so next thing is we've got this kind of highly sophisticated act was the poisoning of the downstream RPC infrastructure. Again, yeah, I mean, on this, from what I understand is that you're supposed to have at least like 3 to 4 to 5 RPCs that you're using to access a lot of these different, basically to access the chain. And from what I understand, it basically sounds like this whole issue was a matter of lack of nodes on the signing and lack of redundant RPCs on the RPC side to access the chain. And so here's the part that I think people got a little bit upset about, and I don't blame them. Industry's best practice and Layer Zero's express recommendation to all integrators is to configure a multi-DVN setup with diversity and redundancy. This means no single DVN should represent a unilateral point of trust or failure. And so I think everybody solely and strongly agrees with this take, but I think the part that is upsetting is that the part that Kelp and Layer Zero weren't able to put 2 and 2 together, that this was happening, and that Layer Zero had all of these other one-of-one implementations here. Like, I think that's, like, it's easy to write this now, right? But it's, when it's actually, before something happens, that's when these things should be addressed. And so I think this is the part where people felt a little bit, I don't know, they felt a little bit like Layer Zero was kind of just, unfortunately, passing the blame. And so I think that's kind of like where they got that pushback from. And it's not ideal. It's not ideal at all for them or for the ecosystem to have to deal with that. And so just to be very clear here, we're still yet to have a resolution here from either CalpDAO. I don't believe they've came out with their statement yet, unless I'm missing. Let me look at CalpDAO. Unless I'm missing a tweet. No, there has not been any updates from CalpDAO yet, guys, which means that we're basically still operating at the same standalone point that we were prior, which is essentially that we are still yet to really understand how they're going to socialize these losses. And I think that's kind of like the big thing that a lot of us are waiting for. Guys, we've got Rob Hadick from Dragonfly, a GP, after their big raise. I really want to talk about something else other than this, but I think we have to talk about what's happened for at least a bit, because it is affecting everybody across, whether they're, a small protocol, big protocol, small holder, big holder, whether it's sentiment, whether it's fear, whether it's actual frozen assets. It needs to be talked about. So I'm going to get Rob in. We're going to get him all set up and we're going to get started. So we'll be right back and we're going to keep talking about this because I think it's very, very important. Guys, if you're in Restream, I see you on YouTube and on X. I will be answering your questions in the chat and can ask them as well. So just let me know and we'll be right back with Rob. Alrighty, guys, we are live in the Tokenization Time with Rob. Rob, welcome to the nest. I hope you enjoy the view.
Great view.
Not bad.
You know, I've lived in New York for 15 years and never been in the Empire State Building.
Really?
Not once.
Ever?
So, first time.
Wow. Well, welcome. This is a non-New Yorker here coming to the realization that I've got. You know what? A lot of this choice to come up here was part product, part show, part like growing the business, and also part just lore. I just tell my kids like for some part of life, I was going to the Empire State Building each day.
It's great. No, I mean, this is an amazing view. So I'm glad I came up here.
Well, it's good to have you, man. As I kind of told you prior to starting, the unfortunate reality here is that the topic of the day is certainly this largest exploit in DeFi of 2026.
It's been a few of them.
Yeah, there has, as of late.
Yeah.
Where were you when this exploit went down on Saturday?
Where was I on Saturday? I might have been watching the Cavs playoff basketball when it happened. You know, I'm a big Cleveland Cavaliers fan. Okay, so you know, game one they had to go and take it to the Raptors. So like, you know, beat them down bad. So it's good, great. So go Cavs. But no, I mean, it's like the weekend was. It was tough, right? So, you know, we've got a lot of DeFi in the portfolio. Nobody directly affected. Everybody's fine. But, you know, you don't like to see this. Like, you don't want to have something like this happen to the whole ecosystem. It's obviously, you know, all hands on deck to make sure everybody is okay. And so, you know, it was a long weekend for, I think, everybody in the space. Yeah,
it was. And it's just kind of like a bit disheartening, but really just now we're thinking about the contagion and like how this spreads and who's affected. And it's looking like there's a lot of potential affected parties here. You know, this composability of DeFi, right, is a beautiful thing. It's an amazing way to create very unique products that are just not available elsewhere. But when you come in, it also adds this kind of like layered risk, right? And we're seeing that play out real time. And, you know, like the thing that's kind of, you know, upset me is just the PvP on the calm side.
Yeah.
I just don't like to see like the lawyer drafted memos. No one, like, it just doesn't seem like anyone's wanting to help each other. It's just like everyone's covering their own ass.
Yeah, it's pretty clear that, you know, the statement that Layer Zero put out was heavily drafted by lawyers. Like, I think that's very clear. I think you said this before, but I don't think we've seen a Kelp statement yet.
No.
There was like a leaked CoinDesk article where they said they saw the draft of the memo. I am sure that has a bunch of legalese in it as well. I think there's a real liability here, right? And so I think that's obviously what people are worried about. It makes complete sense from their perspective. Their shareholders, you know, potentially their token holders, that like they would end up doing this, and you know, wanting to make sure that they were legally buttoned up. I don't think anybody looks particularly good in the situation right now. Like, there's very obvious issues around the 1-on-1 DVN setup that, you know, while the Layer Zero team has been, you know, very adamant that, hey, they told Kelp that they shouldn't have had the 1-on-1, you know, it seems like, you know, something like 40% of people operating on Layer Zero right now have a 1-on-1 setup. Like, you know, documentation, at least at some point, has, you know, suggested that is fine. I think it's also, we haven't quite gotten the full story from them around how the hack happened. It seems like from like reading between the lines, maybe there was, you know, a infiltration inside the team or, you know, inside their security setup. That's unclear. That might be speculation. So, you know, don't take that for my word. But so there's that piece. And then, you know, obviously from the Kelp side, like they also deserve to, like they should have been more security conscious, right?
Oh,
like
for sure.
There's, you know, we've seen, even if 40% of the DVNs are 1-of-1, 60% of people, and you know, and if what they're saying is true, which is that the Layer Zero documentation said, hey, like this is what you should be doing, there's still 60% of people who decided that they looked at the documentation and that is not what we should be doing. Like, we should be more security conscious. We should be more on top of it. There's a lot of people who have put in their own like throttling mechanism as well on the lending side. And so there's a lot of teams that were much more on top of it than they were. And so there's, you know, neither of them look good. They're both pointing the fingers at each other. And then, you know, there's the Aave situation, which, you know, we can talk about, you know, what type of assets should be able to have a 93% LTV, right? Yeah. But you take all of it and you look around and you say, there needs to be more thoughtfulness around the real risk of what some of these wrapped assets present, and there needs to be more thoughtfulness around, what cross-chain, what it means to be, having an unbacked token on, when you're doing a cross-chain bridge, right? And like how we should think about what that risk looks like, and across the L2 ecosystem versus mainnet. And so there's going to be a lot of conversation around this, I think across all of DeFi for weeks, if not months.
Yeah, I'm sure you recall 2024-ish. We were in this era of like restaking being the primitive that was extremely exciting for Ethereum itself,
Yep.
but also highly controversial, right? And there was this kind of like, this poses a systemic risk to Ethereum, the protocol, not necessarily the DeFi layer, but like the protocol. But a lot of folks were pretty adamant that the restaking wrap tokens were also a threat. And I think now we're kind of seeing that systemic threat happen. I'm just curious, like, how much of this do we think is like this isn't a restaking problem?
No,
but
that's not. I think that's a red herring.
Right. But think about like the dynamic of that era of like the points farming and the wrappers and the race and the way that Eigen and Carrick and Symbiotic were all kind of going at each other, and this whole kind of dynamic, like it kind of created this very frenzy-like environment that was very fast-paced, and perhaps some of the lack of critical security thinking here from Kelp derived from that environment of like just ship and go, because we're fighting EtherFi and Renzo and all these other teams, and restaking is the hottest thing, and we're gonna go get a big token launch. It is a red herring, right? But I think that era caused a lot of like just FOMO, and
I think like putting any of this at the feet of restaking specifically, I think is like pretty obviously wrong. Like any sort of wrapped asset that's going like across like the Rollup ecosystem, like very clearly this could have happened to.
Yeah.
And so I don't see that as a specific issue. Now, I think there's like what you just talked about is really like a startup problem, right? And it's the fact that we have a bunch of technology startups that are not operating like they are financial services businesses, right? And so there's this, old adage of like move fast, like break things, right? But that is a software conversation, and people think that a lot of founders and entrepreneurs think they are building software when they are building finance companies, right? And so there's not enough thoughtfulness and enough just what I would say responsibility taken for software and for projects and for businesses that are at the end of the day securing and frankly in many ways operating or managing hundreds of millions of dollars, right? So there's a reason that the bar in call it traditional fintech or financial services is much higher for how you roll out new software, right? There's a reason that is very high, and it's because of the fact that when you lose money, it is obviously a much bigger issue than if you're like whatever B2B software platform like doesn't work as the way it should be, right? And so I kind of tweeted this over the weekend, but there are some founders who seriously understood the responsibility they were taking when they took in tens or hundreds of millions of dollars into their protocols, and there are many, many founders in our space who have not, right? And I think there's a lack of seriousness and a lack of responsibility across a lot of the ecosystem. Now, this isn't meant to denigrate DeFi as a whole. It's not meant to denigrate all of the well-meaning and well-acting founders that are out there. But the problem is this is a space where a lot of the way people have underwritten rolling out these BD partnerships or underwritten rolling out these new integrations has been around, to your point, like how much yield, how many rewards, like how many, like what do I think is like interesting from can get this net new depositor, and there has been not enough thoughtfulness around what it means to be have the right security set up and to have the right OPSEC. And I'll make even a kind of a separate point, which I think there's also been a lot of conversation on the timeline about AI and mythos and like how the surface area is like much more it's much more vulnerable in an age of AI. But all of the big hacks we've seen lately have nothing to do with AI.
Not at all.
Absolutely. They're all about a lack of seriousness at the teams themselves in terms of how they think through their security setups.
Yeah. Yeah, and I think that was very evident in what happened, while in the actual announcement from Layer Zero, it was a bit kind of vague and broad as to what happened. Sources very deep in this matter have anonymously kind of passed several tips over that it was indeed an internal compromise of a key of a certain internal process that allowed this to happen.
Yep.
And then not only that, if you think about the way that, and look, I'm not here to point fingers and to blame Layer Zero or Kelp, or just an objective look at how these DVNs have been talked about, decentralized verifier networks, to kind of come out and say that they're this kind of like this decentralized immutable tech, and then underneath is a one-of-one in-house signer. That also feels like a little bit misleading and a little bit wrong as well, not just from the security perspective, but from the way that these products are talked about. So I think there's also a regime change in the way that marketing a certain products, like nuanced decentralization, is going to occur, and there's probably going to be a lot more pushback and acceptance of pushback from people who are going to say, look, no, like this is not decentralized, like let's look under the hood.
Yeah, and I think, listen, decentralization is part of the story. There's there's like layers of what decentralization actually means,
Yes.
and I don't put it at like the feet of like, oh, we just need to be entirely decentralized, because there are obviously teams that are much more centralized that are doing taking this more serious as well. I do. The one thing that I would say to what you said, though, which is, I don't know who looked at that statement, but when you come out and you make the point multiple times, the protocol worked as intended, but the protocol working as intended meant that you lost $300 million.
Yeah.
Like, maybe that's not the statement that you should be putting in there, because maybe it worked as the software intended, but clearly there should have been some change to the software so that didn't happen, right? And so I that to me felt just like the wrong tone and defensive in a way that was probably not appropriate for the situation.
Yeah. Let's talk about the risk curation side. I mean, I've been hearing quite a bit just at DAS and through rumblings, through having conversations with institutional asset managers, whether they be curators, funds, family offices, et cetera. People from that world, right, are coming and they want to provide better risk management services on chain. And so when it comes to something like Aave allowing RSETH to be listed and to not have identified through Chaos Labs, through BGD, or just through themselves that this was a one-of-one DVN asset, like how do we grow from here, right? Like, rather than being like, this is bad, we all messed up, like what is the necessary steps here to implement stronger risk management practices going forward? Is it just you need to bring in smarter people, bigger money, like what is how do we do better risk management on chain?
Listen, it's not like we need smarter people. Like, the Chaos Labs team and Gauntlet teams, like, these are incredibly smart people, right? Like, these are some of the smartest people I've ever met in my life, and most of the people that work those places are smarter than I am, right? And so that is not the problem. I do think there is a broadly an incentive problem in the space, which is that oftentimes, I mean, it depends on if we're talking about Morpho versus Aave, and this has kind of been the point that's been made about, how curation works. But some of these curators, obviously, they get potentially compensated by percentage of AUM, right? And if you get a percentage of AUM, but then also you're, call it tasked with making sure that risk management is appropriate, well, there is a push-pull there, because, like, obviously, if you are the result, if a hack results because of you, like, you might lose all of your AUM, but you're obviously trying to always push for more AUM. And this is the incentive problem that exists in traditional finance as well, right? Which is, we're seeing it on the private credit side, where, people have an incentive to try to increase their AUM, but does that mean that they're out on the risk curve, right? And it's being too far out on the risk curve, where does that break, right? And so there's that, right? And then there's just, like, broadly, there's also everyone else involved is also, I think, incentivized by just, having more AUM, right? Yeah. And so that, and again, I'm going to make the point, this is not a crypto specific incentive issue. This is a broadly like a finance incentive issue, which is just that, everyone who gets paid more, having more AUM. Having more AUM typically means having more yield, or, a higher APR. And so getting more exotic products, being further on the risk curve, allow you to have, call it that higher APR. And in crypto, relative to traditional finance, most of the capital is probably less sophisticated in terms of actually pricing that risk, right? And because also the treasury rates have been so low, and like the on-chain, like call it basic like USDC markets, USDT markets, the return on that has been so low. There's been this I think real just hunger for like better more yield, and so that's I think what's driving a lot of these decisions. I don't think we solve that by I don't think there's a crypto specific way to solve that. There's just you sometimes just have to learn the lesson the hard way, right? When you look at traditional finance, like how did we learn the lessons around to think, tranching mortgage-backed securities, right? Like we went through this really bad thing, and then there was regulation on the other side. In crypto, there is no regulation that stops us from doing that. And so we have to self-police. Well, how do we self-police? That's a hard problem, right? Yeah. And that requires a lot of coordination. Probably it requires some sort of, call it like independent body that we try to have people, call it opt into, that reviews maybe lending and markets that, call it, it goes through a first review from the risk manager or the curator themselves. Then it goes through independent review of some sort of, whether it's like a Moody's type rating agency or something like that. This is something that people have been thinking about in the space for a while. Again, it's all about incentives. And maybe we've reached a point where after what has happened the last, call it, few months, that people will want to opt into something like that. I don't know if we have.
Yeah. One of the lessons that I've heard many investors come on the show and say is that investing is path dependent, right? You get these certain outcomes based on, circumstances and events that are almost out of your control or entirely out of your control. Yeah. This is a very good example of how the future of DeFi going forward is path dependent on something like what's been happening for the last couple of months. And there's luck involved in that, right? Like a lot of the Sky guys and the Spark guys are like, kind of out there, like not cheering, but, saying like, look, we avoided this and we did this with our markets and this is safe and this is safe. And then you've got other folks who are obviously having to deal with these losses. In terms of this kind of path dependency, like, is there a way to anticipate what the maybe incumbents of DeFi will look like as a result of this event in the future? Or perhaps like how you would think about this path dependency of exploits or unfortunate events as it pertains to like the longer term investing outlook in the space. As an investor, how would this kind of change your views?
So I don't know if it actually changes my views at all.
Okay.
But that might be because, like, I already had maybe different views than the market. I think the reality is that I'm not sure that I have seen the general feeling around DeFi be this bad since FTX, probably, or maybe Luna was worse because that was much more DeFi contained. It's very clear that there are a lot of people. I mean, you can listen to every podcast in space right now. People are saying, "Oh, like, well, is the risk reward of being on chain at all appropriate anymore?" They're seeing tweets about this from some of the largest DeFi traders, et cetera. And I think there's this mentality is going to continue going forward. Now, I also think I go talk to all of the large investment managers and the banks and everybody getting, call on the traditional finance side who's looking to get involved in the space. And all of them see how much or how interesting of things that they can build if they're doing it on chain. Now, what's not going to happen is that there's never going to be an Apollo pool that is using collateral from restaked ETH. That's just not going to happen, right? And so in some sense, it matters less to them about some of the stuff that's happening because they're going to have segregated pools for their assets and it's going to only be paired against pristine collateral like a USDC or USDT or something like that. And so, their perspective is well, I can actually build better product on chain. I can build a more modular product on chain. I can serve my customers better. I can go more global. And I will continue to do that on, Morpho or Aave or, Upshift or Midas or one of these things, right? But I will only do that and very tightly controlled, more segregated markets. But that was already what they were thinking about doing. Like that is not net new. The broader stuff that's happening around, some of this like more exotic collateral, like that is a very crypto native specific thing. And I do broadly believe that market is going to be much tougher from here on out. We invested in Athena in I guess it was like July or maybe June of 23, right? And at that time, everybody looked at us and was like, "Man, this is crazy," because Luna just happened. Like, isn't this the same thing? We were like, "No, it's very different. Like, from a risk perspective, like this is why it's different. This is why we wanted to invest in it." And then Athena basically kicked off this new market, right? So obviously, like you mentioned Sky and what they've been doing, but this new market of having different types of collateral for different types of ways to get yield on chain. Athena basically reinvigorated that, and that's basically they were the beginners of what we've seen over the last few years, in my mind. And people saw their success, and they went further and further down the risk curve. They went, they were less focused or more focused on growth and less focused on security. And that part of the market, these people are taking as much risk as possible to grow as quickly as possible, move as quickly as possible. I think we're going to have just a repellent from a lot of those.
Okay, that's a very, very interesting point, because I just had Shu Yao from Mega Ethan here, asked her about, they built Mega Ethan in a way it was just single sequencer, juice the hell out of it. Forget all this decentralized sequencing crap. Just go in, make the most performant possible, L2. Hyperliquid has been dominating 16 nodes in Tokyo. Nobody cares. Hyperliquid's winning it. In fact, and people are tweeting at me like, "Oh man, you're virtue signaling now, but you've been speaking about Hyperliquid for the last 3 months, man. You got to, get your facts straight, right?" And so there has been this no, decentralization doesn't really matter. Speed, performance, product does, and the market is seemingly kind of accepted that. Yep. But you're saying that's going to get a big pushback in the crypto native space specifically.
No, so that's not what I'm saying, because I actually think people still will not care about decentralization. Okay. Right? And because I actually decentralization is a form factor or a way to be more secure, but it's not necessarily needed to be more secure. In so much as the way that crypto natives talk about decentralization, right? Okay. It's meaning that you can have a a 15 of a 16 multi-sig, right, and be a centralized company, right? So it is not necessarily that you were gonna, and I definitely don't think we'll actually have a kind of a revolt or repellent away from the people who are centralized, if people think that they are taking their jobs more seriously, right? What I do think we will see and I guess my point was more specifically around the lend borrow, money markets, and collateral, because there's been a push to use more and more wrap tokens, more and more call it further out on the risk curve, call it we're calling these stable coins or wrap tokens that have something that's less and less stable underneath them, right? To proliferate that in DeFi. And I think that part of the market is going to get re-rated because of the risk. People are going to be less open to taking that type of risk. Listen, there's a lot of tweets about Hyperliquid. Having known Jeff for a little bit, and I think they will do hopefully as good a job as possible on the security side, and it's been on their mind a lot. And so, but I don't think I still don't think people will. Consumers just do not care about decentralization.
Yeah. On that, so is it fair to say that the vault isolated lending model is going to reign superior over time to the pooled model? There's obviously pros and cons of both, and we don't even need to make this a morpho Aave, I think, because Aave is already kind of thinking about this with V4. But in instances like this, in this kind of heightened risk environment, right? I remember in 2020, Aave had 5 assets: ETH, Rep, Bitcoin, Chainlink, USDC, and USDT. That was the only 5 on V1 and V2 every time. And then, as you say, it kind of grew and now grew out of proportion. Do you think that the isolated model even though that has its cons, is going to be the kind of leading growing model for the institutional adoption for larger allocators because they want that control? Or kind of how do you envision this market
the
changing?
institutions, like that's the only way they're going to operate.
100%.
Yeah, 100%.
Just the vaults.
Yeah, that's the way they're going to operate. That's the way they've been operating today. This type of stuff only makes them want to operate like
Right.
that, more cleanly. It obviously does have, drawbacks, right? Relative to like how we think about capital efficiency and being able to make, call it, full set of like most fulsome returns, and broad composability, right? But you're never going to convince a Fidelity or an Apollo or even like a Revolut who, they might just, maybe Revolut just wants to have a Bitcoin product like Coinbase has on Morpho, right? But, Revolut's going to want their product to be segregated because it's going to, there's regulatory reasons for that, but and accounting reasons for that, but there's also just risk reasons for that as well, right? And so I think if your perspective is the same as mine, which is that, call it this next phase of growth is very institutional, then, and when I say institutional, that also means, call it, distribution channels through fintechs and through, banks and things like that to consumers. So like B2B to C, then that is the only way that proliferates.
Yeah, interesting. And then, we had this rise of these, quote unquote stable coins, yield coins, you could say. Also different types of wrappers and different types of like collateral backings. Athena actually notably just came out and expanded their collateral backing as a result of kind of the basis trade changing, more RWA backing and more kind of interesting commodity based trading strategies, et cetera. Curious, like when people are thinking about risk here for these wrapped, Ethereum assets, they'll probably naturally start to think about the risk of USDE and of other stable coins, USDS, and all these kind of yield coins. And now that the stablecoin markets are being affected in Aave, where a lot of these looping strategies were being ran, I'm curious kind of how you think the market reacts to these, not stable coins, but yield coins, not these Genius compatible things, but these actual like yield generating stable coins, if you will. Is there going to be pushback there? Is there going to be more acceptance? Is there going to be an opinion, or is it just going to kind of be the same thing?
No, I think it's like the teams that have proven that they take this seriously and have proven that they like understand how to manage risk. Like they will continue to be the assets that people, that people flock to, right? It's going to be harder for what I would say like a net new startup to win. I think the trust of people today, unless they go about things in a certain way. But for something like an Athena or a Sky, right? The Athena guys and Guy and his team. They were ahead of the curve pretty much every step of the way in terms of how they thought about security, right? And so they've done, when it came to, even like 1010 with USDE, when they had the, isolated USD DPEG on Binance, they were specifically telling Binance to that they needed to have direct mint redeem enabled, and that they needed when they thought about how they were thinking about their Oracle setup, that it couldn't just be to their own order book, that it needed to be much more broadly. And had Binance gone and done those things, we wouldn't have had the DPEG on Binance, right? Yeah. And so when we think through how that team has operated, they've operated with a level of professionalism that has put these other teams over the last few weeks at shame, to be honest, right? And so it's important to understand the risk that you're taking in these products, whether it's Athena or Sky or any of the other numbers of challengers out there, and to understand what underlies that risk. But it's also important not to reflexively kind of I would say like try to act like this is like an issue because it's is non-standard, it's like non-US dollar risk, right? And so from if you are going to enter into a position that says, okay, well, like I understand that this is the basis trade. I understand that the basis trade can turn negative. I understand that this thing is, call it, has a tri-party agreement. So none of it is, actually on, is posted to the, exchange itself, but that there's this, 2-hour period where I could lose that P&L if things went awry. Like when you understand that risk, and that risk is very clearly laid out for you, then these products, they're just financial products, right? Yeah. And they serve an important part of a big financial ecosystem that's building around DeFi and crypto. But it's just about understanding what those risks are. And some teams have been better than others about being very clear about what they're doing. Some teams have been better than others about being very clear about what their Oracle setups look like, about what their custody setups look like, how they think through managing times of stress. And those battle-tested teams, I think, will actually be better coming out of everything that's happened in the last few weeks.
Yeah, I would anticipate a consolidation of capital as well, right? Once these funds on Aave become unfrozen, I anticipate also kind of a changing of capital structure and in terms of people allocating there or elsewhere, but generally seeing more of the creme of the creme kind of become more enshrined, become more of an incumbent.
Yeah.
I wonder what you think about the trust deterioration as a result of the frozen funds for the last 48-ish hours, right? Like, I'm kind of, for one, a bit shocked that the main ETH market and a lot of the stablecoin markets are still bricked on Aave. I think as every day goes on, like the trust, it goes down a lot. And the users are the ones that are suffering from the PvP comms and lack of cooperation here. At the end of the day, KelpDAO has to make a choice here, I believe, is kind of what the sentiment and what the common consensus is. I'm just curious how you think about the trust as it pertains to the frozenness of these funds. And then this is going to kind of take us into a conversation about rate limits, about T+1 settlement, about these funny things that TradFi has that we've kind of avoided, but now are seemingly coming back into the conversation as like a way to kind of backstop and to prevent what's happened to happen again.
Yeah, I maybe take a little bit of a different view here, which is that everyone is working tirelessly behind the scenes of like figuring out how to get the best possible solution for depositors, right? And so this is taking a long time, but if you allow a run on the bank, it is literally it's net bad because it's literally just bad for the markets. It's bad for whoever the last person out is, right? And it's not. It usually doesn't allow for us to get to some sort of agreement that is maybe probably the most EV positive thing for everybody, right? And so there's, I think, a general understanding of that is okay. I'm probably gonna get like blown up on Twitter about this because like everybody's wants to get their money out, but I think like that's fine. And there, I can tell you, I can't tell you exactly what, but I can tell you that, we've been part of conversations or people have hit us up about things that they're trying to do to try to figure out what's best going forward. And so people, it's not as if there is no work happening, right?
Of course.
Now, that maybe goes against like the general ethos of what a lot of people think about when they think about DeFi. But the reality is the space is getting more institutional. Like we talked about earlier, everybody's clearly lawyered up. Everyone's trying to figure out how to, formulate a response. And what ends up happening in terms of like, who takes what losses when and how much is still very much up in the air. But I think it will be, whatever it ends up being, it will be better than if we had allowed, these markets just to have a run on the bank, right?
Yeah.
So I guess that's point number one. What was your second question?
Then the thought was around, okay, this could have been prevented if this mint function on RSETH had a $10 million per 10 minutes, or $100 million per hour even, right? Or if Aave had a limit on the amount that you could pull out or deposit at a given time. Could be every hour, every block even, something, right? Just something to make it harder than just like, a false swoop of a button and boom, and all of a sudden you deposit 300 mil, you pull out 200 and then you're gone, right? There's also this kind of like meme going around. Mert tweeted it like, oh, so this is why TradFi has all those middlemen, right? And people are like, no, buddy, that they're the cause of the problem. But talk to us about kind of how you envision rate limits or more kind of concrete on-chain security practices to prevent large-scale exploits. Obviously, you can't prevent everything, but how do you envision the space evolving from that perspective as far as like maybe learning a bit of something from traditional world, or at least implementing more guardrails upon the true ultimate open liquidity dark forest that exists today?
Yeah, so I responded to Mert's tweet because if you look at the last like 5 or 6 years of DeFi, the people in DeFi learning about what happened in TradFi and like learning the same mistakes is like probably the most undefeated thing that has happened over the last 5 or 6 years, because you have a bunch of like interested technologists who like haven't worked and a lot of them have not worked in finance and are like, oh, how would I build this thing if it was in first principles? And then they're like, oh shit, like this is how you manage risk. Like that's a lot of what's happened, and unfortunately it's happened with a lot of other people's money, right? And I guess getting back to what we talked about earlier with some of the more serious teams, like people like Athena, they'd already done that. They'd already had rate limits, right?
Agora said that as well.
Agora said that as well, right? I'm sure there's a bunch of others who have done it, right? Because there's absolutely no need, and it makes absolutely no sense for someone to be like, yeah, I got a full port 300 million right now. Like that makes no sense.
Yeah, no.
Right? Like, and that would never happen in any market. There is no institutional real investor who would be like, oh yeah, this has to happen this way, right? There would never. It's a little bit annoying, but it would never get real pushback from anybody who's thoughtful about it. And so, I think the reality is that you don't necessarily need a bunch of middlemen like Mert talked about, or maybe you need more. But you do need, like fully being able to allow people to do whatever they want at any time they want is like clearly not like the best solution, right? Yeah. So doing things like putting rate limits in there, like I think that's going to be standard from here on out, right? Yeah. I don't know why anyone would not have had that, and I don't know why it wouldn't have been the standard on for a lot of these markets. And this is not a new conversation, right? Like a lot of the teams were building this themselves already. And so, like, if they were building it themselves, obviously there was already conversation happening about it at Aave and Morpho and et cetera. And so I do expect that with how much damage has been done over the last few weeks and over the last few years, I do expect that we're gonna have more fulsome conversations around putting in some of those more TradFi like checks and balances going forward. And you know what? If it really bothers you that you can't put $50 million into a single borrowing market and in one single transaction, then like, you know what? Who cares? I honestly I could care less.
Yeah, yeah. But so there's a spectrum here, right? There's like where we are now on chain DeFi, and then there's like T+2 settlement and like KYC and everything that comes with that. The lack of composability, the wires, the ACH, the bank accounts, right? Like somewhere in the middle here is like, the tempos and like the cantons and like the corporate blockchains, if you will. And then like somewhere in here is probably where we're going to end up getting closer to for the more like open public chains. Yeah.
So, I mean, even traditional markets are going away from T+2, right? And so, like, there's I think it's very clear that something, and we talk about this a lot in payments. So this is kind of a specific point because I think it's been more talked about in payments recently and with stablecoins. Atomic settlement is not something that a lot of people want, right? And so like we talk a lot about like atomic settlement being like this big unlock. The reality is like that is actually how most payments happen. And while people want faster settlement than we have right now, atomic settlement is probably not it. And so like, what is the middle ground to your point? I think we're all still figuring that out, to be honest, right? And there's risk, there's like credit, there's, how do you think about, how much risk is too much risk? There's KYC, and there's like all of these things that go into, okay, well, why should we potentially throttle a transaction or have some sort of settlement time baked into the transaction? I expect that these markets are going to just continue to bifurcate, which is that you have the institutional markets, and we talked about, okay, we're going to have siloed, segregated, asset management, specific, institutional markets. You're going to have the same thing is going to happen on the payment side, where you're maybe atomic settlement happens in the system, but you KYC at the at the entry points, right? But there's going to be these markets where you have permissionless DeFi over here, and you have the smart contracts and the protocols that people can interact with. And then you're going to have a lot of the institutional side of the market over here. And there's going to be, a lot less of that. There's going to be a lot more of that, call it, throttling and that KYC.
Yeah.
I expect that. So it depends a little bit on the regulatory environment. Where I think most of the industry is trying to get to, if you think about not just what's on Twitter, but like, what's happening in DC, most of the industry is trying to get to, well, let's, KYC people at the endpoints, and let's let the protocols, do the thing that they are supposed to be doing to the best of their ability. And maybe there's segregated markets. So the protocol, you can take full control and full use of the technology and your KYC at the endpoints, but everything you do in these like walled gardens is able to be the way that, you would intend the software to be. And I think that is probably where we are going, but it is going to be a segregated market from everything that happens on restaked ETH across all of the L2s. And that is, I think for a lot of people, not the world that they wanted to see when they came into the space.
Yeah.
And I think for a lot of people, doesn't ideologically fit with the things that they believe. And they, still continue to believe that, crypto is meant to be like cypherpunk permissionless money. And there is a part of that market that will continue to exist. I just think if I look 10 years in the future and I think about like the market cap and the economic activity that's happening on chain, I think the part over here, the institutional part, will just dwarf everything that's over here.
Yeah. Last thing from my side on, kind of on this point, on the more kind of retail DeFi on-chain finance that a lot of us, who are listening and a lot of people who've been around for a while have kind of come to grow and love, there's often this inverse relationship with central bank rates to DeFi rates, because borrowing activity of stablecoins is very high when interest rates in the macro are low, driving more speculative activity. You borrow a lot of stablecoins, you get long. The rate goes up, all of a sudden DeFi is amazing because the risk-free rate is 2%, 1.5%, 2.25%, but the DeFi rate is 4.5%, 5.5%, because people are willing to pay that. And then obviously what's been happening as of late is the opposite. It's the risk-free rate's 3.5%, 3.75%, the DeFi rate is 2.5%. It's terrible, right? But this too shall pass, and this will change. I think probably quicker than people think. With that being said, what do you see as catalysts to kind of reverse the sentiment, around the entire DeFi complex and generally the way people think about this asset class? This bear market's not been that bad from a price perspective for the majors. For the other tokens, it's been a bit rough. It's been almost like a cold front, at least from my perspective. It hasn't gone on long enough. We'll see how long it does last. But the sentiment is really, really bad, and the perception, I think, has suffered once again. Not to the same level of FTX or anything, but internally. Yeah. What are some catalysts that are going to drive a turnaround here for the market, for DeFi?
Yeah, but people, I think this is like not super obvious if you don't think about it really closely. But the last maybe 16 months have been probably the single most value destructive months of crypto history, and it's for retail specifically. And this includes FTX, this includes Luna, because when you look at what happened, you had the Trump meme coin, and then you had Melania, and you had everything that came after that, and all the drawdowns. You had the tariff tantrum, and then you had what happened on October 10th. And you look at this, and you look around to the retail users of DeFi, and now all the hacks that we've had recently, and it's hard to see a world where probably 90% of the retail users have lost a significant amount of money over that period of time. And at a time when risk assets more broadly, we're back at all-time highs in the equity markets, insane. Right? And so I think that, along with what you just said about rates, has made it really hard for people to see the risk reward of just being in DeFi and just being in crypto as worth it, unless there are people who have already made their wealth on chain. And I think there's probably a lot to be said about tax situations that are going on there, and how people are thinking through the future of their wealth. And so what do you need to get those people excited about the space again? I hate to say this like this, but you probably just need better price action, right? Because like the reality is when people figure out that they can make money, they come back into the space. And then if we can get more controlled price action on, you know, the way up and like less volatility, it means less institutional interest from a trader perspective, but it probably does mean more long-term oriented retail capital can come into the space. I think there's another point that you made there, which is, okay, well, like the majors hasn't been that bad, but the altcoins have been. I do think we're about to see, and we've been seeing a lot more dispersion, and there's just a lot less correlation, right? It used to be the case where, you know, I'm sure you remember 21, where like, you know, you went from a major to whatever the meta was at the time, and every AMM went up, and then every loaning protocol went up, and then every gaming protocol went up, and then like, you know, it didn't matter if you were in the biggest piece of shit that ever existed, like, you know, it went up with these other things that went well, and that's just that era is gone, right? It's going to be harder to invest in this space. It's going to be harder to trade the space, and you're going to have. It's no longer going to be about finding beta, which is basically what everybody had before, and it's going to more be about finding alpha in the future.
Rob, thanks for joining, man. I appreciate you joining.
Thanks for having me.
Tough week for DeFi, tough weekend, but we will get through this as we always have.
Yes,
and
absolutely.
ladies and gentlemen, that's the show for today. I see you guys on YouTube. Toss a like, throw a subscribe. Thank you for joining today. We'll be back tomorrow. Hell of a weekend. You can hear it in my voice. There's a bit of somberness. There's a bit of reality checking for anyone who was affected. Wishing you guys the best. Hoping KelpDAO can come out with a better statement than what they're currently planning, which is just to shoot down layer 0 and have more kind of legal mishmash. But we will see, ladies and gentlemen. Robbie will be back on the show, I think Wednesday, so it should just be me tomorrow. See you guys then, and stay safe out there.